Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your October monthly trending report. You know, as I come to you at the end of September, I think about last month and what we talked about just a short month ago. You know, when we think about the month of September, historically, it's been a bad month in the market. The average return for the month of September since the 50s has been a negative 0.68%. It's one of the reasons so many advisors and so many people on television tell us if we're not going to avoid September, we need to at least be careful about September. And one of the things we talk about, of course, when it comes to the monthly trending report is focusing on trends rather than on feelings. Think about what's going on in the world today, where we were a month ago, and what we were thinking about coming into September. The idea that September is a bad month in the market kind of had us bracing for some losses. Maybe even thinking about getting defensive, taking some profits off the table, and sitting back and just letting September happen without us. Well, if you've been following a disciplined, unemotional investment approach, you were most likely invested for the entire month of September. And what a good decision that was. Now, I started out by saying historically the month of September is bad. There's a saying in the investment world that past performance doesn't guarantee future results. Because even though we may have a good grasp of what an investment strategy is going to do, or we can historically look at what the stock market has done, the past doesn't predict the future. And so before I get into charts and graphs and things like that, we sit here at the beginning of October realizing that the stock market for the month of September was up 3.5%. The S&P 500 index gained 3.5% in a month that is historically negative. It just goes to illustrate the fact that when we allow our investment strategy, our long-term investments work, that short-term investing is something we have to get through. Volatility sometimes is something we have to put up with. But predicting what the market's going to do is really hard. Think about a month ago what the headlines were. The problems that we were supposed to have with tariffs, the issues about judges maybe saying that tariffs were illegal, or inflation was going to go up, and interest rates were most likely going to change. And all of this stuff was going to happen. In the end, a disciplined investment approach is always going to serve us better. We don't know what the market's going to do for this month of October. We don't know what things outside of the market are going to do for the month of October. But we know if we have a disciplined investment approach, we have a chance for long-term success. Now, last month, one of the things I showed you was the probability of a market's reaction to interest rates being dropped. And it was a wide swath of positive to negative what has happened based on historical performance. And as you may know, interest rates, the Fed cut rates by 0.25%, which was what was expected. It wasn't anything out of the ordinary. They didn't do a 0.5 point, but they did cut. And so based on that cut, certainly the markets reacted positively. So what happened in the last month? one of the things we saw was that stocks rallied as the Fed resumed easing. What we see here is that tech led all sectors in September. You can see for the most part, and this is how the S&P 500 average works, there were more positive sectors than negative sectors. Real estate is still negative because interest rates are still high. Energy is still negative because the price of a barrel of oil is still low. Consumer staples, materials, these things are still negative, but overall, we can see that the market was positive. Now, it's really interesting because what we're looking at here are sectors in the marketplace. And of course, sectors represent a bunch of different companies and a bunch of different stocks in the market itself. I think one of the really interesting things to look at is this idea of investing by themes. And just to be really accurate here, what are themes? Themes, investing around themes can be investing around technological advancements like artificial intelligence, robotics. You can see the top of the list here is Bitcoin. There are themes like clean energy, sustainable agriculture, themes like an aging population or e-commerce, things like that. You can see that the themes that were very popular in September had a lot to do with interest rates and a lot to do with technology and some of the exciting things that are going on. And so here is your top asset flows by theme. So exchange traded funds, the Bitcoin ETFs, had the most asset flows in the month of September, followed by AI and automation. You see Chinese technology innovation, uranium, and nuclear energy. All of this stuff, if you go from clean energy, infrastructure, natural resources, miners, scarce resources, blockchain, all of this stuff they're themes inside of the technology arena. And so it's one thing to stay invested at all times. It's another thing to allow different strategies to look for maybe sectors that are showing stronger momentum, or indexes that are showing stronger momentum, like the NASDAQ or the NASDAQ 100 or the S&P 500. There are a bunch of ways to be exposed to the market. And we talk a lot about risk management and the importance of managing risk for the long term. Having money managers that might look at exit strategies on a daily basis. Should we be in or out of the market today? Other managers that make weekly decisions about how they're exposed to the market. Some managers do it on a monthly basis, but they're all making determinations based on risk. The other thing that our money managers do formulaically on a disciplined schedule and unemotionally is they also can look at where should we invest if we're going to be in the market. A lot of them are looking at momentum. They're looking at specific inflows and outflows, and they're trying to put your money to work in places that it makes sense to take risk right now. And so when you look at what I just mentioned, the S&P 500 was up 3.5% for the month of September. It means it was a good time to be invested. It doesn't necessarily mean that you did 3.5%. Maybe, depending on how you're concentrated in your investments, you did a little better. Maybe you did a little worse. But what you should have seen for the month of September were positive gains. And that's what the trends continue to show us. And this slide and the slide before it dial in on those trends. What's really popular right now? What's moving most of the market right now? It's just a very interesting time to be paying attention to what's going on in the stock market. Where is money moving? Where are people making the most money? And you can see, especially on this chart, a lot of the stuff that saw a lot of money come into it is very speculative. It's very risky. It's very volatile. But based on risk management. When a risk manager determines now is the time to take risk, they often move towards risky assets. And that's what you see on this chart. I just think it's really interesting. And so, as I mentioned, the month of September, typically a negative month in the stock market historically, was a very good month. The 1 month trend continues to be positive. Always bumps in the road. Always the opportunity for volatility to give us a little more growth if we're exposed to it. But again, despite the headlines, despite what's going on in the political world, whether it's overseas, whether it's in the halls of Congress, the market continues to move in a positive direction. Now, again, we can ask all kinds of questions. We can be fearful. Yes, it's going in the right direction, but I don't know why. I don't feel good about it. All of those are reasonable things to consider. But when you have this disciplined, unemotional approach to the stock market, when you've got strategies that are investing based on formulas, they're not taking into account the human emotion that is the headlines. And because your strategies and your money managers are looking at data, you have the opportunity to interact in the stock market and with the stock market in an unemotional way. So we saw some volatility this month, but again, the overall trend is positive, which leads us again to the trailing 1 year return on the S&P 500. You can see that we've recovered from May and April of this year. We saw that volatility, and that volatility has brought us back to all-time highs on the S&P 500. It's brought us back to a positive market. And again, based on the measurements that so many of our money managers take, we are most likely exposed to the rising market. And most likely, our investments are growing, regardless of what happened between March and May of this past year. The overall trend, although there is volatility, is still positive. Always good to step back and look at, again, the last 5 years in the market. There's uncertainty. There has been uncertainty. There will be uncertainty. But one of the things we have to guard against is our short-term emotions. I heard something that made a ton of sense last week, and it was another advisor saying that nobody wins when they make investment decisions based on politics. And if you look at this 5-year chart of the S&P 500, it puts an exclamation point on that sentence. Regardless of your politics, regardless of how you feel about the current administration or the last administration or the midterm elections coming up next year or anything else going on geopolitically, your feelings about politics should not interfere with your long-term investing. You've heard me say before, short-term emotions kill long-term plans. And the only way to experience long-term success is being committed to a long-term investment approach. And so as we continue to see headlines that may cause us to get emotional, cause us to worry, cause us to want to take action, let's determine to keep our emotions in check and to allow our long-term investment plan to work out over these short-term volatile experiences. Because you can see being committed to a long-term plan over the last 5 years has given you the opportunity to experience growth, hopefully in a way that has been palatable to you, a way that has allowed you to stay invested and get through this volatility in order to experience the success that you see on the screen here. I don't know what's going to happen in October. I don't know what's going to happen for the rest of this year. But I know that I'm relying on unemotional, disciplined formulas that work on a set schedule to make decisions not based on feelings or human emotion, but based on data. And because of that reliance, I can look at the trends on a monthly basis, knowing that I have the chance for long-term success because of the activity that goes on in my investment strategies. This is Kevin Roskam with USA Financial. This has been your October monthly trending report. Thanks for listening. I look forward to seeing you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.